So we've seen the S&P sort of stall out really since July 3rd, and right now we're in the July OPEX window, and so it's not entirely strange to see this kind of pinning effect going into Friday's option expiration date. But again, right now we're still continuing to hold this 10-day exponential moving average, and as I've been telling my subscribers in the member area, that as long as you stay above that moving average, it's hard to get too bearish on the market. Obviously, if that level were to break, things start to change, and you can start making cases for a move back down. But right now, as long as that level holds, that's pretty much been what this whole market has been based on the last couple of weeks, where we've just been, every time we get to that level, we find support and we move back up. The only time we fell below it was here, and that was for one day. So it wasn't enough to get anything really going to the downside. So right now, that's the big level that I've been watching and using as a gauge in terms of when this market may turn. But obviously, we're seeing volatility compressing when we look at realized vol. The 10 and 21 day kind are down to like 7 and 8%. So those numbers are pretty low. Again, we're getting to the lower end of volatility again, and so when that happens, it really kind of limits how much the market can move on a daily basis without pushing implied volatility higher. The other thing is we're going in now to earnings season, and right now we're also seeing implied correlations get down to really low levels, and historically implied correlations get to these low levels right ahead of earnings seasons, and then they tend to revert. So for example, the last couple of times we've been in, so the last 2 Julys, we've seen implied correlations bottom out right around July 19th, July 15th, and here we are today. Right now it looks like we bottomed around July 10th. So typically when implied correlations bottom, that's typically when you see some sort of turn in the marketplace, and this is because of the volatility dispersion trade that goes on specifically around earnings season. Because typically around earnings season, what you see is implied volatility on the equities, individual equities within in the market go higher, and you can tend to see implied volatility on the index level going lower. And so there's a clear seasonality to it. And right now we've been in this pattern of implied volatility has been trading inversely on stocks versus the S&P 500, and that's really a marker of this implied volatility dispersion trade that goes on during this time of the year and ahead of earnings season. And you can see that pretty clearly. When I take Tesla out, it's a lot clearer even, because again, you can see that this is a negative correlation. So basically, again, what this is showing us, which is showing us more clearly, is that when you look at the 1 month correlation between S&P 500 implied volatility and individual component volatility for these individual stocks, they're actually going inverse to one another, and that's what's causing this big drop in implied correlations in the marketplace. And typically what happens once you get past earnings season, implied volatility levels will decline sharply, and this trade will basically unwind. You can see it last summer. It happened right before that big blow up into August. You basically see implied volatility levels drop pretty meaningfully once the companies start reporting results, and then that trade typically unwinds. So this is part of the other issue right now at hand with the market. You have this period of time where implied correlations right now are very low because we have this dispersion trade taking place. That's probably going to be ending. It's probably already in place, and probably by the time we get to next week, it's going to really start unwinding, because you're going to start getting a lot of the Mag 7 names to start reporting results. And typically, again, when you see implied correlations bottom, you typically get major, market tops. In fact, this was when we had it on February 18th, 14th, 18th. You saw implied correlations bottom, and that corresponded with the market top. and the unwind of that trade led to this decline in the marketplace, at least into March. Obviously, also, like I just said, realized volatility is really low, and that also kind of complicates things when it's terms of the market going higher from here. So right now, and then of course we also have the TGA, which is going to be in the process of possibly rebuilding. We're not going to know all the details until we get the quarterly refunding announcement at the end of July. But basically, the TGA is expected to go from about $300 billion in liquidity to about $850 billion in liquidity. And that's going to basically mean that reserve balances at the Fed are going to probably start declining in a more meaningful way. And that's going to basically start sucking liquidity out of the equity market. So we're already starting to potentially see those first warning signs of that happening. SOFR, which basically traded up to 437 today. This comes out every morning at 8 o'clock. If this number starts ticking higher on a daily basis or starts getting into like an elevated range above 440, 445, that's probably a really good indication that liquidity in the overnight funding market is getting really tight. And that may actually result in, some lending that goes on in that market to eventually get pulled back on. Think about margin levels to get pulled back on top of the fact that you have reserve balances falling. So like when you kind of look at where the market is right now, although like I said at the beginning, we haven't seen the index really fall below the 10-day exponential moving average, we're kind of coming into a period of time where you have the process of the TGA rebuild going on, the implied volatility dispersion trade potentially coming to a point where it's going to potentially unwind. You have realized volatility levels that are really low, and you have this potential rebuild in the TGA, which is going to work to drain liquidity out of the market. Plus, we're going into an earnings season, which, to be honest, we have no idea how it's going to go. ASML today just reported results, and they're the company that makes all the machines that make the chips. They basically gave pretty lackluster guidance, and the stock was down pretty hard today. Tomorrow morning, you're going to get Thursday the 17th. You're going to get Taiwan Semi reporting results, so that's going to be an important number. So there's a lot of stuff going on over the next week to two that also could be market moving from a news cycle. Plus, we obviously have the August 1st now trade deadline coming. We have these headlines around Jay Powell potentially getting fired. We're also hearing rumblings again that maybe we're going to find out about semi and pharmaceutical tariffs by the time we get to August 1st. So there's a lot of different pieces going on here, and I think you can basically see that the market has kind of gotten stuck again. And so it's not to say that it can't go higher. It's just to say that there's a lot of things going on right now that really kind of favor it giving back some of what we've seen in the last couple of months, really off of the August levels. And depending upon how it unfolds, there could be quite a distance to go because, again, we've kind of gone up on a lot of air, and obviously NVIDIA has been a big driver of that. And so that's kind of where we are as of today. Anyway, please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again soon. Bye.